Hi, and welcome to this week's market presentation. Latest news. In the latest developments regarding the Russia-Ukraine war, President Putin traveled to Alaska to meet with President Trump to discuss a potential ceasefire and peace deal to end the war. The meetings between Russia and the U.S. ended earlier than anticipated, with neither a ceasefire nor permanent peace deal having been announced, as was the goal of the U.S. administration coming into these talks. However, even though limited progress was made on ending hostilities, some of the positions from both sides became somewhat clear. On the Russian side, Russia is now demanding that as part of any ceasefire or peace deal, that Ukraine would have to give up additional territories, including the entirety of the Donbas, even parts of the Donbas which are still under Ukrainian control. On the other hand, the U.S. proposed that even if Ukraine is not given membership into NATO, that in order to reach a more permanent peace, there would need to be firm security guarantees given to Ukraine in the form of Article 5 level type guarantees. From the sidelines, Zelensky praised the prospect of such firm security guarantees given to Ukraine, while also reducing or saying no to the prospect of giving up additional territory to Russia in these negotiations. European leaders and President Zelensky are set to travel to Washington to meet with President Trump to continue the peace negotiations in order to try and end hostilities. Regarding the impact on energy markets, the additional sanctions that the U.S. had been threatening on Russia if no progress was made on a ceasefire appear to now be on hold as the U.S. holds off from imposing those additional sanctions. Additionally, the tariffs that the U.S. was planning to introduce on countries purchasing Russian goods, especially Russian energy products, appear to be on hold as well, with the prospect of those introduced against India in particular being delayed from implementation. Weather. Onto the latest weather forecast. Temperatures across Europe, which had been significantly above average over the previous week due to a heat wave across the continent, are expected to come down, with temperatures cooling off, particularly in the second half of this week, before ticking up again, particularly over Western Europe. Precipitation is also expected to pick up over the next week, although still remaining somewhat limited, with the precipitation outlook for the coming weeks remaining relatively dry for this time of year. Lastly, in terms of wind speeds, following a decrease over the past week, which worsened wind power generation output, wind speeds are expected to remain more or less the same over the next 7 to 10 days. Lastly, looking at the Atlantic tropical weather outlook, we note Hurricane Erin, which has formed over in the Caribbean, moving towards Florida. The latest forecast places its path along the U.S. eastern seaboard, although for the moment it is not expected to make landfall on the U.S. East Coast. The risk to U.S. LNG exports is certainly reduced given its current projected path, but it remains to be seen if there will be changes to that, so we'll keep a close eye on these developments. Microeconomics. The inflation figures for the U.S. over the month of July were released over the past week, which showed year-on-year inflation remaining stable at 2.7%, while core inflation ticked up once again to 3.1%. The increase in core inflation and the fact that year-over-year inflation has not come down, moving closer to the 2% target set by the Federal Reserve, is increasing the odds and the likelihood that the Federal Reserve will move forward with interest rate cuts in their September meeting, given the growing signs of a slowing U.S. economy, as seen by the disappointing jobs report released in July, as well as the somewhat underwhelming growth figures in terms of GDP over the first half of the year.
crude oil and LPG.
Moving on to crude oil markets, crude oil prices saw relative stability over the past week, with prices moving just around 1.6% for the front month for WTI and just around 1% for Brent. Anticipation of the outcome of the meeting between Trump and Putin certainly kept markets from showing too much movement. And now that the prospect of additional sanctions or secondary tariffs have eased to some degree, we could see further downward movement towards oil markets, particularly given the improved supply outlook as OPEC Plus continues to move towards that increase in output quotas by next month. Looking at the EIA's petroleum balance outlook, we note the increase in the supply forecast throughout the next year, in part driven by the continued production increases out of OPEC Plus. But we also see increases in the demand forecast driven by some more optimism regarding a reduction in some of the tariffs the U.S. introducing and a likely lower negative impact on the global economy. Nonetheless, the outlook for crude oil remains with an oversupplied situation, leading to the lower oil prices we currently see in the market.
Natural gas.
Natural gas prices in Europe saw a bearish price evolution over the past week, particularly through the end of 2025 and through 2026. The last quarter of 2025 saw a decrease of 4.3% on the week, with the front year seeing decreases of 4.1%. The bearish momentum eased down as we moved further along the curve, but nonetheless, we saw decreases across the board. Storage levels across Europe continued their upward movement over the past week. And compared to the other countries in Europe, we want to highlight the fact that Germany remains below the European average of just 66% full, certainly lower than we've seen over the last couple of years for this time of year. Injection rates into storage decreased over the past week, in part due to the higher temperatures increasing overall gas consumption in Europe, tightening the supply and demand balance and resulting in lower injections. Nonetheless, injections still remain just slightly above the average since 2012. But the decrease in the injection rate did lead to the storage deficit versus the previous year stabilizing around 16% and not narrowing further. In terms of total supply and demand, the higher temperatures and greater demand from the power sector certainly led to an increase in total gas demand in Europe, moving it up from the lows that we saw the prior week. On the other hand, total supply remained relatively stable, just slightly downwards, largely due to that continued decrease in both LNG imports into Europe and in turn LNG sendouts. In terms of the European supply mix, we note that switch between North Sea production and LNG sendouts for the larger source of natural gas into Europe over the last few weeks. Taking a closer look at the supply mix, we note that Norwegian gas flows have remained relatively stable, just slightly down over the past week, but still in line with the levels seen over the last couple of years. On the other hand, LNG sendouts have now continued to decrease now to the lowest levels so far this year, and while still above last year's levels, certainly at a lower level there. In terms of global LNG export price competition between Asia and Europe, we note more LNG cargoes going towards Asia. Part of that is only some of the lower demand that we see in Europe for LNG imports. And on the other hand, we do see greater demand out of Asia as the higher temperatures in the region are increasing the overall gas burn there, resulting in additional demand for new arrivals. Looking at European gas demand, we note that particularly industrial and local distribution zone demand has remained near the bottom of the range over the last few years. Then we look at gas to power demand, even with the increase over the past month due to the warmer temperatures across Europe, due to the summer weather conditions, we're still looking at overall gas consumption at the bottom of the range and certainly below the average over the last 7 years.
Coal.
Coal prices globally have also seen a decreasing trend over the past week, with the API2 index falling 3.5% on the week. Prices for Asia, looking at Newcastle index in particular, saw slightly less bearishness over the past week with decreases of 2.6%. On the supply side of things, we can note the decrease in domestic production out of China, in part due to weather conditions with heavy rains disrupting production domestically, but also by the actions taken by the central government to crack down on overproduction there. The higher temperatures in China are also leading to additional demand for coal, which is now increasingly being met by imports rather than domestic production. On the other hand, looking at India in particular, there we see lower demand for coal than had been anticipated due to the high level of coal stocks in the country. Over in Europe, we've seen an increase in the ARA coal stocks over the past week, and given the decrease in gas prices over the past week, we're also seeing some additional coal to gas switching as gas-fired power generation becomes more competitive.
EU and UK emission allowances.
Over onto the emission allowances, we saw a bearish price evolution for the European side of things, with prices decreasing around 3.5%. One of the big drivers of the decreases in the carbon allowance price is also the bearishness that we see in gas markets, reducing the overall price level due to a reduction in coal-fired power generation share as we see some coal to gas switching. On the other hand, as the compliance deadline is approaching on September 30th, we could begin to see some additional buying demand and buying activity as we near that deadline. On the UK side of things, we do see a little more stability with smaller decreases over the past week, with prices still settling at higher levels, very much on the back of those expectations of that linkage between the EU and the UK markets. In terms of overall power sector emissions in Europe, while we do see that nice uptick over the past week, very much driven by the warmer temperatures and the increase in the gas burn in Europe, we do note overall power sector emissions at the lowest level since at least 2019. Investment positions have seen an increase in both the net long positions for Europe and the UK as market expectations shift over the past week.
Electricity.
Electricity prices in Europe have also come down over the past week. Looking at German power prices, we note a similar evolution as natural gas, with the decreases being more pronounced in the shorter term, particularly again the last quarter of 2025 and through 2026. The decreases are more modest further along the curve, in line with what we saw in natural gas markets. Here, the bearishness in gas, but also carbon prices adding to the bearishness in the electricity sector. Looking at other markets across Europe, we see a similar evolution as that of Germany, with prices decreasing across most markets. One important exception is certainly the Nordic region, which has not seen as much bearishness, especially when we look at those prices in Norway, partly due to the drier weather forecast that we see in the region and the worsened situation regarding the hydrological balance and hydro reservoir levels in the area, which have worsened the hydropower outlook for the second half of the year. In terms of total demand and residual load, we saw an uptick over the past week in line with the higher temperatures and the greater cooling demand that became as a result. In terms of the supply mix, we continue to see very good levels of solar power output, increasing the share of solar power generation. Nuclear has also seen some positive movement, particularly over the last couple of months. But we do see that the increasing in overall demand for electricity, particularly over the past week, was more increasingly met with fossil fuels, mainly natural gas, with that share of the power mix increasing lately. Taking a closer look at the supply mix, nuclear power generation, which had seen notable improvements through July, saw gradual decreases in output over the past week, very much driven by the warmer river temperatures which are used for cooling needs across those reactors, and as a result, we're seeing overall output come down. In terms of renewable power generation, we saw a decrease compared to the prior week, and this was mainly driven by a decrease in wind power generation, as I mentioned earlier. As this coincided with an uptick in overall demand due to the higher temperatures, we saw that being increasingly met by greater output from fossil generation, particularly natural gas. Taking a closer look at the renewable power mix, we see that drop in wind power generation following the highs that we saw the previous week. On the other hand, compensating some of the decreases in wind power generation were certainly the uptick in solar power output to record highs for this time of year. In terms of the fossil fuel generation, we note that sharp uptick in fossil gas power generation, increasing from the lowest levels over the past 5 years to slightly above last year's levels. In terms of hydro reservoir levels in Europe, we note the deteriorating picture, particularly in the Nordics, where the surplus versus the average from 2015 to 2024 has narrowed quite significantly over the last couple of months in particular, due to the drier weather. Overall, across most countries in Europe, we're now seeing a hydro level deficit versus that average, as opposed to a surplus as we saw earlier in the year. Lastly, looking at the guarantees of origin, we note a more stable price evolution compared to the great volatility that we saw, particularly a few weeks ago. Prices have remained relatively stable, particularly for 2025 and 2026 over the past week, as more market participants settle their position and as more clarity forms regarding the output outlook for the second half of the year.
That covers this week's market presentation. Thank you for joining.